Welcome to the Daily Update. This is being prepared Friday, February 18th, where we'll look at the action in the market today and then see how things look for Tuesday, February 22nd. Please remember that on Monday, the financial markets are closed in observance of President's Day, so there won't be any action to talk about. So we have a nice 3-day weekend, and I hope you're enjoying your weekend so far. We had a pretty negative day on Friday. We are seeing things more negative, and a lot of this is now geopolitically driven. There's a lot going on between Russia and Ukraine, and depending on what video you watch on YouTube, what channel you watch in the US, you may be led to believe that things are just about ready to explode or that things may be getting better. We just don't know at this point, and this is a real potentially explosive situation that could erupt, and the markets will react to that. If things calm down, if things seem to be more diplomatic and people are talking instead of firing weapons, things may turn back more positive. Also, you have a lot of the short-term players in the market that, especially given the geopolitical events right now, they probably didn't want to carry any long positions over a 3-day weekend. So that probably gave in to some of the selling on Friday as well. So let's go back over what happened. We did have a pretty flat open. The futures had been strong during the night. It looked like we were going to potentially get a bounce. But as we got closer to the open, the futures went right back down to the flat line. And so we pretty much opened on Friday where we closed on Thursday. We sold and got almost down to the 43.30 level. But then we saw some buying coming in, and this was kind of positive. We were able to see enough buying to rebound back up to the unchanged level. Now, were those new participants going long? Or were they short sellers looking to close out their positions? They have to buy in either case. We don't really know that, so we can just take it by what we're seeing on the screen, and we got almost back to that resistance level of unchanged, but then we saw some late day selling after that. We closed in about the mid-range, kind of the lower part of the middle of what happened on Friday. And we ended up being down 0.72%. Volume was above average, which is not surprising before a weekend, a 3-day weekend in particular. What we're talking about now, what we're fixated on, are the technicals, and they are negative. Pretty much every chart that I'm going to show you suggests that we might have further to fall from here. But at the same time, we have to be aware, are prices going to continue to go sideways the way they have over the last couple of weeks? Or are we going to look at some kind of a bounce? We have to look at all three scenarios at the same time. But our charts are negative, so we have to go in that direction. We're still kind of getting through the earnings season. Inflation is still at the backdrop of everything that's being talked about. And when you talk about inflation, you also talk about interest rates and then the geopolitical concerns, with the biggest one being what's happening between Russia and Ukraine. Some of the comments, prices now we're back down into that short-term range that we've been through for the last few weeks or so. And just like we saw on Thursday, we saw the same thing on Friday. Yields fell, which a lot of times will give support to stocks, at least in this environment, but yields went down and stocks went down. So they moved together. And then Russia, Ukraine, as well as what's going on in Canada, continue to dominate the news. The economic reports that came out on Friday did show some strength, where on Thursday, we saw some reports come out that were more weaker than expected. Well, on Friday, they were stronger than expected. The market continues to be overvalued in a longer term basis. And because we had a down day, our ADX is suggesting that the trend is strengthening. The bias is negative, that's from day to day, where the momentum, that's usually 2 to 3 days, they're both negative. right now. So we are headed lower. But in the background, you still have a longer term trend that remains positive. We might see that in danger, but I'm going to try to look at some of the more positive things throughout this video just to give you some ideas of what to look for, some reference points that you can use as you analyze the market. So as far as sentiment, we're not at a fear stage. We are drifting over to the left, which is more negative than positive. But looking at it on the historical chart, we're still in the mid-range. We keep bouncing around just like the market has been bouncing around. We have an up day, people feel a little bit better. We have a down day, people feel a little bit worse. Overall, they end up kind of where they started. Then with our VIX, this is a potentially positive where we did see a little bit of a decline on a closing basis with the VIX, even though we had a down day. And if you look back to when we set this other base that we're going back down into, look at how much higher the VIX was on a closing basis than where we are right now. That means there's a little bit less fear as prices continue to fall. Now that can change, and that doesn't mean we're going to get a bounce. That's just something to be aware of. And we see the same thing on the bar chart where fear had been a lot higher. Well, it's now lower than it was when we're getting down to the same price levels that we were at before. So that could be taken as a positive, even though we're still seeing a lot of fear in the market overall. It's just less fear right now. With the VIX of the VIX, this also declined a bit on Friday, looking at the bar chart, as well as closing down slightly. Then for those of you that just watched the weekend videos, I pointed this out after Thursday. We had the AAI survey asking individual investors, do they feel positive or negative about the market? Well, when this report came out, they are mostly feeling negative. And when we drop below 20, that's more of an extreme reading. They're getting a little too fearful right now, a little too pessimistic. That could potentially provide some support for the market. As far as our sectors, we were down pretty much across the board. 10 out of 11. We had staples that were up slightly on Friday, but everything got hammered, with tech leading things to the downside right now. Then, since the all-time high that we set, energy has been performing well. And we're kind of going back and forth as to what's doing the worst right now. The staples, I'm sorry, I don't know why I want to call this staples. This should be discretionary, the things that would be nice to have, but you don't have to have. That's now back in last place. Where we have our Chernobyl green is communication. Real estate is also down. We're also looking into the technology. So we're seeing a lot more negativity as far as our sectors, where most of these had been near the center line for the most part. As far as inflation, the BDI did not help us on Friday. We're still living off of what the CPI came out with last week. As far as FedWatch, just to review, this is where we were on the day that the CPI came out. After the CPI was released, now we're switched back to more, okay, maybe they won't raise interest rates really to a higher degree at the next Fed meeting. And then this is where we are after Friday, where they're really suggesting now that it'll be 1/4 to 0.5% at the meeting in March, where the 0.5% to 0.75% is seeing less likely now. And if the Fed does what it's supposed to do, they should be following this. They should do what the markets tell them to do. This is one of the things that is getting a bit frustrating, is people are looking to the Fed and then making decisions based on that. It should be the other way around. The market should be doing its thing and the Fed should be reacting to the markets, but it doesn't always work out that way. Then to give you some perspective, where we're seeing the 0 to 1/4%, that's dropping off. Well, now we're seeing this green line, 1/2 to 3/4. It's bouncing up and around, up like a roller coaster. And we're seeing this kind of orange line, brown to orange. It's coming down. And so there is some real indecisiveness now about what the markets think will happen. And this will get adjusted as we get closer and closer to that meeting. As far as the technical alerts, they were all negative across the board. Especially this could be negative if you're in gold right now. We dropped back below 1900, but Toronto, with all the mess that's going on in Canada, that's TSX. It had a bearish MACD crossover. NASDAQ had a bearish crossover on a weekly chart. The euro bearish, that could be potentially good for the dollar because the dollar and the euro go back and forth. NASDAQ crossed below 13.7, then 6, then 5. Let it be over. The S&P 500, it crossed below 50, and I'll show you a chart of that later, where communications set a 52-week low. The Dow then ended up crossing below 34,000, and tech, the BPI crossed below 30, which is a potentially oversold reading when it crosses back above 30. So we are in oversold territory right now. That might provide some support. So even though this is a negative alert, it might take some time for this to play out, but that could give some support to prices going forward. Intraday, here is the open on Friday. There really was no gap up or down. We saw some initial selling, initial buying, and then we went boom. We sold down and went negative. We crossed down below S1, chopped around a little bit, got almost down to S2. This is when we saw some buying coming in, and this made things look a lot more positive. Well, as we got closer to the close, we saw some more late day selling, and we ended up being down 0.72 overall as far as a percent. Then how this looks on the bar chart, and there's potentially some positive things you could take from this. The low that we set in January, it's still holding, and we're still above that. And we have a previous low set at about these levels. This could work its way into a bounce. Now, if we break through this, you might see an initial acceleration. You don't want to necessarily take that as we're breaking down from here. There are probably lots of stop loss orders set right at these levels. And if we pierce through this support level, you might see those stop loss orders triggered, and that will just produce more of a real downturn. That's kind of what we saw back here when it looked like we were breaking down. These were all just stop loss orders being triggered because then we ended up going up from that point. The same thing might happen if we see follow through weakness. But you have to look at this and say, all right, we had a chance to really break out here and we didn't. So you can just conclude right now that this is negative. Any attempts at a recovery bounce have been met with more selling. Then we are down 9.33% the way I measure it from the all-time closing high that we had here down to the close on Friday. So we have not even got into correction territory yet. This is just a pullback as of right now. If we continue to fall, yeah, we're going to be in a correction, but it hasn't happened yet. Growth saw a decline on Friday with value seeing an advance, more of a defensive posture, where when we compare the growth index with the value index, we are seeing growth declining. And if you were to flip this chart over, you would see value outperforming growth right now. Looking at the NASDAQ 100, which has got a lot of tech stocks, that is really underperforming the S&P currently. As far as our trend, it's a little bit hard to tell here, but we saw an advance with the red line, which is negative or selling, and a decline with the green line, which would be buying. And so the ADX is turning up ever so slightly, suggesting if we really do break down, the trend will kick into gear and it will be a negative trend. If we see a bounce out of this, look for the ADX to weaken. Then we finally have our signal now with the mass index. We went above 27, we dropped below 26.5. So now we're just kind of waiting back to see what is going to happen. And we are at a potential tipping point. We could break down from here and this trend could really get moving, or we could bounce up this way, see some renewed strength. So we can't really pick which direction things will happen right now. As far as the decision point, they did update the charts. Trend models are neutral, where their PMO in the short term, it finally switched back to being negative. Intermediate term is negative, but long term continues to be positive. Breadth, we saw declining breadth again on Friday. It wasn't as bad as Thursday, but it was still negative. So based on price and volume, we are dropping lower. We still notice this negative divergence here. Price is breaking down, but it's above the moving average, where volume is below the moving average and going lower. So that's another thing to be concerned about. ADX ratios, I don't know, why do I call this ADX? The advanced decline ratio, we're below zero and falling. New highs and new lows continues to trend lower. The accumulation distribution, we're right back down to this moving average, although we did decline again on Friday. Short term, we're well below the 20-period moving averages. We have to go quite a bit up from here for this to even act as resistance. Our moving average study, 20, 50, and 200-day moving averages continue to decline. And according to this chart, we still have more room to go before we get to an extreme reading. Our moving average spaghetti chart here, we have lost all of the moving averages that we follow, with the 200-day moving average being very important for the S&P 500. So now we're slightly below here. MACD has now turned negative. The STO, which is kind of doing some screwy things right now, it's probably because of this real mess that we've been in for a few weeks. It actually turned up a little bit on Friday based on price and volume, even with the down day. But it's negative overall. The McClellan oscillator continues to be negative and is declining. Our really touchy indicators, the Stochk RSI is now into oversold territory, as is the Williams percent R. Force index is showing a continuation of the weakness. Intermediate term, I took the 100-day moving average out of here because we're getting far away from that. But on the 50 period, we are below the moving average. And again, we would have to see some pretty hefty buying come in for these to even act as resistance right now. Then the PMO study. Sorry, I can't edit this out. We are negative with the PMO, as well as based on price and volume. Our PMO study, with those that are rising, continues to decline. Those that are producing buy signals also is declining. And those that are above zero is kind of flatlining. Forgive me for that. I'm sorry. Till I get my other software, I can't take these flubbubs out of here. This is what I'm talking about with the BPI. We dropped below 50, and that showed up in the technical alerts. Moving average rainbow, we're now down near the bottom of the rainbow. Stochastics are showing that on a short-term basis, we're now oversold. We're headed lower intermediate term, and we're going lower in the longer-term full stochastics. Summation index continues to fall based on price and volume. Almost all of our momentum oscillators are turning negative. The slope, which had been hanging in there, has rolled over. The MACD is also negative. These are our two longer term momentum measurements. They're hanging in there, but showing some weakness, where our shorter term momentum measurements are now decidedly negative. And this is another crazy thing. The Chaikin money flow, we had Thursday as a down day and Friday a down day, but it continues to advance. So it's not sure what it's picking up right now. Then this is a potential positive. The Pring bottom fisher is good at picking when we have been in declines, when we might see a bounce up out of that. It crossed a number of days ago, but nothing has really happened yet. So we're seeing a delay right now. The vortex, it's falling off based on the buying power and increasing based on selling. The CCI, we're now down into oversold territory. As far as our trading systems, the Elder system is negative with the red bar, and our SAR continues to be negative with the dots above. Our different charts, the Heiken Ashi is showing a bigger candle after Friday's action, so that is negative. The Kegi chart, it's still looking a little bit more negative with the red. And we finally saw something on the Renko. There was enough of a drop on Friday to draw in a little red box. 3-line break is also looking more negative. Equivolume also looking more negative, with the ease of movement indicator showing that we are headed down. The path of least resistance, at least after Friday, is down. It doesn't mean that's what will happen on Tuesday, but we have to go with what our charts are telling us. There was a new zero drawn into the point and figure chart with Friday's decline. So this is more negative, shorter to intermediate term. Long term, we still have the blue upward trend line that we are not really in danger of messing up right now. Then as far as our Fibonacci retracement, we did come back down to the 38.2. We lost that, and now we're headed down closer to the 50% retracement. Long term, this is more positive. Again, we've dropped slightly below the 200 period moving average, but the line hasn't rolled over yet. So that could be seen as positive, both with the arithmetic scale and with on the weekly chart, we're also looking okay. And here is a monthly chart, monthly to date. We're just slightly below the longer term moving average. Now, our logarithmic scale, yeah, we've dropped below the red line, but the red line is still going higher. This is a daily chart. Here's a weekly chart. We're kind of camped out on the moving average. And on the monthly basis, we're just a little bit below. So if you look at this in times past, we've been at this point before only to see things bounce back up. We've also been at this point before only to see things come crashing down. The special K continues to go sideways in the short-term chart, and then looking at it in a longer-term context, it's also going sideways, but it's negative since it's below the moving average. S&P, we're back down to this bottom part of this range we've been in. Mid caps also showing some weakness. Small caps, they're still back in the whole mess that they never really got out of. The FANG stocks, yeah, there needs to be some serious buying if these guys are going to pick back up. We were down 2.21% on Friday. We're below the moving average, and we've had a death cross here. ARK was down almost 5% on Friday. It's really having some problems right now. Doesn't mean it won't recover, but right now it's not looking very good. The Dow, we dropped below the pivot. We're below the 200-day moving average. Now we've got some space if we're going to come down to S1. Small caps, chopping sideways below the pivot, below both moving averages. Mid caps, same thing, below the pivot, below both moving averages, and the shorter term moving average is starting to show some distance between the longer term moving average. NASDAQ also looking at a potential death cross on this chart, and we have seen some real negative price action. NASDAQ 100, shorter term moving average is coming down. We're below the pivot and we're below the 200-day moving average. The Vixen, this is also potentially positive. We're coming back down to where we were before, and we're seeing the Vixen not show as much fear. Now we go back here to what we saw last spring, and we're about at the same level we were before. So half full, half empty. This is just something to be aware of and to watch. NYSE, this had been holding up fairly well. The moving averages, although are weakening, still remain with a positive trend, but we're below the pivot and we're below the 200-day moving average. The S&P 100, the big guys in the S&P 500, they continue to underperform the rest of the S&P 500. The Wilshire, it's back down into where we've been consolidating for the last few weeks. We're below the moving average, we're below the pivot. Looking internationally, China is kind of rolling over, but you have emerging markets, Europe and Japan, trying to turn up to flat in Japan, where the S&P in the US, yeah, it's rolling over ever so slightly, but still looking somewhat positive. Taking all stocks together, we're seeing the shorter term moving average show continued weakness. We're below the longer term moving average and prices below both. Then I only show this ever so often. This is intermarket analysis going back 1 year, where at the beginning of the year, if you got into oil, you'd be looking really good right now. Where the S&P is showing some declines, the dollar has been holding up, even though it's flatlined here. Inflation is kind of eroding the dollar power right now. It's not that we're seeing a decline. Where a year ago, we saw the dollar decline 10%, but yet the markets went up and inflation was still tame at that point. So pay me now, pay me later, pay me all the time. Then gold is seeing a little bit of a breakout, even though it declined slightly on Friday, where bonds on a price basis have been really showing weakness, but over the last week or so have been showing improvements. As far as the broad market, here's the dollar, where it's holding up. We're right at about 96. And here's the weekly chart that finally finished for the week. We're just at the closed at the upward moving, the top moving average, and we're above that slightly. Oil saw a little bit of an advance on Friday. We're just over 90. Gold, even though we were down slightly, you could call this an inside day. When you take this in the context, we broke out, but we've been at this level before. However, the moving average has crossed above. That's a golden cross, but this is looking more like a roller coaster here with the moving averages crossing each other. Silver also was up a little bit on Friday, but we're below this moving average. However, the shorter term moving average is starting to turn up. CRB was pretty much unchanged on Friday, but overall, we're seeing a real solid uptrend. Bitcoin, which finally dropped below 40, it's running into some problems. And as it trades over the weekend, I'll keep an eye on it. But in the short term anyway, we are seeing some problems. And based on this chart, we saw a death cross a while back with prices continuing to fall. We could be putting in, if we see a bounce back up, we could be putting in a bigger picture head and shoulders topping pattern. As far as bonds, we saw a little bit of a recovery in the 2-year on Friday. So our spread is showing a little bit of a bounce. Again, where we get real concerned is when we drop below this red line. That usually signals a recession. The yield curve based on the 3-month, no, it's not helping us. And then looking at some Fibonacci retracements here, where from the high up here to the low after the COVID plunge, we have retraced now more than 50%. What had been acting as resistance is now acting as support, but we dropped below 2% on the 10-year yield on Friday. And we saw that pretty much across the board. 30, 10, 5, and 2 all had declining yields, the 3-month as well. But that still didn't help stocks. Here's just a look at the different international yields right now, with the US having the best yield of all, but is still at 1.92%, is nothing to brag about, especially when you compare it to inflation at 7.5. Bonds on a price basis continue to fall. Then our corporate bond index actually rebounded a bit on Friday. This is based on price. Here is the yield, where we're at about 3.34% as far as what you would get if you were to buy AAA corporate bonds. Then another thing to look at too is our spread when we look at bonds. These are riskier loans against not as risky loans. And if we were really freaking out, we would see a real spike. Well, we're not seeing that here. So yeah, it moved up. So we need to keep an eye on this, and it's higher than it has been in the last year or so, but over actually higher than it's been in the last few months. But it's not giving us a real panic type reading at this point. Now, looking at some relative studies that I usually go over on the weekend, here's gold to the S&P. It does look like it could be breaking out. Here we have domestic or non-US developed stocks. So if people are saying buy foreign stocks, well, yeah, they've turned up, but they still have a long way to go to get above this red line, and the red line needs to turn up as well. So this is a monthly chart that we're seeing here. Here's energy versus the S&P, and we're looking at a daily chart here. Energy has been breaking out. Here is a weekly chart. We're right at the moving average. We closed a little bit above that. And here is a monthly chart. We're still a little bit below the longer term moving average. Then looking at tech versus the S&P, tech has been seeing a lot of selling. We are breaking down, but we're right at this moving average right now. Here's a weekly chart. We're still above the moving average. And here is a monthly chart so far, because we're about halfway through February. We're right down to the moving average currently. So it doesn't look like things are falling apart. It could get worse from here, but so far things have been holding up. Then also looking at staples versus discretionary. Up on top here is the S&P. Down on the bottom is a ratio between the staples, which we're seeing breaking out. Those are the things that people have to have, versus discretionary, the things that it would be nice to have, but you don't have to have. Well, staples are seeing, after seeing a real decline, they are breaking out. But will that continue is the big question. Then this is also looking at this on a weekly basis. The S&P is on top, the ratio is on the bottom, and then here is a monthly chart. Yeah, it's showing a lot of improvement for staples or value, but it has a ways to go before it breaks above the moving average, and then we would like to see this red line turn up. So what can we look for on Tuesday? The markets are closed on Monday for President's Day. The markets remain in that short-term range, and I'm going back about a couple of weeks. We'll have to see. Are we going to get more into the high part of that range on Tuesday, or are we going to drop down and test some of the previous lows? We're still dealing with some earnings coming out. There's still this battle going back and forth between growth and value. The economic reports that are coming out on Tuesday are consumer confidence. Then we have a housing price index that'll be coming out, and then the Case-Shiller home price index also coming out. And then we have the purchasing managers index that comes out that sometimes can have a little impact on the market. That's a preliminary IHS Markit manufacturing services PMIs, purchasing managers indexes. And then we have all this mess of what's going on in the world right now. Russia, Ukraine, the Olympics are wrapping up. The Iran meetings, which I haven't really paid much attention to lately. I'm just watching oil. And then all the craziness that is currently going on in Canada, which is now taking its toll on their stock market, which is why you're seeing their index generate a negative signal. So our conclusion right now is that the S&P is negative and range bound currently. Short and intermediate term remain negative. Long term, the bias remains positive, but because we're dropping below some longer term moving averages, that is showing some weakness. So I hope you have a very nice weekend, and I will talk to you again after Tuesday's session.